Invoice discounting. Invoice discounting change of purchase of trade rates at a discount by provider of the discounting service. Invoice discount and factoring are linked, and mostly factors also provide invoice discounting service too. It involves the purchase of a selection of invoices by the factors. Also provide invoice discounting service to it involves the purchase of a selection of invoice by the factor at a discount, but the invoice discounter doesn't take over administration of sales, client sales later. Confidential invoice discounting is an arrangement whereby a date is assigned to the factor confidentially, and a client customer will only become aware of arrangement if he doesn't pay his date to client. Non-confidential invoice discount is an arrangement whereby the client customer is aware of the relationship of factor to client and acknowledges its liability toward factor. Managing foreign account receivable. Foreign account receivable co-management. So reducing investment in foreign account receivable. Forfeiting, letter of credit, counter trading, export credit insurance, export factoring. For managing foreign account receivables, say reducing investment in foreign account receivable. A company can reduce its investment in foreign account receivable by asking for full or part payment in advance of supplying goods. However, this may be resisted by consumers, particularly if competitors do not ask for payment upfront. Okay. Forfeiting involves the purchase of foreign account receivable from seller by forfeiter. A forfeiter takes on all the credit risk from transaction. Involves the purchase foreign account receivable from the seller by a forfeiter. A forfeiter takes on all of the credit risk from transaction without recourse, and therefore the forfeiter purchases the receivable from seller at a discount. The purchased receivable become a form of debt instrument such as bill of exchange, which can be sold on money market. The non-recourse side of transaction make this an attractive arrangement for business, but as a result of cost of forfeiting is relatively high. The non-recourse side of a transaction make this an attractive arrangement for businesses, but as a result of cost of forfeiting is relatively high. Letter of credit. This is a further way of reducing the investment in foreign account receivables and can give a business a risk-free method of securing payment for goods or services. There are a number of steps in arranging a letter of credit. Both parties set the terms for the sale of goods or service. Letter of credit. There are a number of steps in arranging a letter of credit. Both parties set the terms for sale of goods or service. The purchaser requests their bank to issue a letter of credit in the favor of their sellers. The letter of credit is issued to the seller's bank, guaranteeing payment to seller once the condition specified in letter has been complied with. The goods are dispatched to customers, and the shipping documentation is sent to the purchaser's bank. The bank then issues a banker's acceptance. Letter of credit continued. The seller can either hold the banker's acceptance until maturity or sell it on the money market at a discount value. Okay, it takes a significant amount of time and therefore are slow to arrange. The use of letters of credit may be considered necessary if there is a high level of non-payment risk. Customer with a poor or no credit history may not be able to obtain a letter of credit from their own bank. Letter of credit are costly to customers and also restrict their flexibility. Collection under a letter of credit depends on the condition in the letter being fulfilled. Collection only occurs if seller presents exactly the documents stated in the condition. Counter trade. In counter trade, the counter trade arrangement, goods or services are exchanged for other goods or service instead of for gas. The benefits of counter trading include the fact that it facilitates conservation foreign currency and can help business enter foreign market that it may not otherwise be able to. A disadvantage: the value of goods or service received in exchange may be uncertain. It includes complex negotiation and logistical issues, particularly if counter trade deals involves more than two parties. Export credit insurance. Export credit insurance protect a business against the risk of non-payment by foreign customers. Exporter can protect their foreign account receivable against a number of risks which could result in non-payment. Export credit insurance usually ensures insolvency of purchaser, slow payment, insures against a certain political risk, for example, war, riots. Disadvantages include relatively high cost of premiums and the fact that the insurance does not typically cover 100% of the value of the foreign sales. And this is a export factoring. An export factor provides the same function in relation to foreign account receivable as a factor covering domestic account receivables and can help with the cash flow of a business. However, export factoring can be more costly than export credit insurance and it may not be available for all countries, particularly developing countries. General policy for foreign account receivable. None of the method detailed above would allow the sailing company to escape from the basic fact that credit should be given only to customers who are creditworthy. Managing account payable. There are three main objectives of account payable management: seeking satisfactory credit terms from suppliers, extending credit periods during period of cash shortage, maintaining good relationships with suppliers. Total credit, trade credit. The cost of lost cash discount can be calculated. Trade credit. Example: product Q. Okay. Managing cash. Objective of holding cash. Join Maynard Keynes identified three reasons for holding cash: transaction motive, precautionary motive, and speculative motive. Transaction motive: every business needs cash to meet its regular commitment of paying its account payable, like employee wages, taxes, and dividends. Precautionary motive: there is a need to maintain a buffer of cash for unforeseen contingencies. Speculative motive: sometimes business holds surplus cash as a speculative asset in the hope that interest rate will rise in future. Problem associated with cash flows: making losses. If a business is continually making losses, it will eventually have a cash flow problems. Even if a business is making a profit, it can still face cash flow problem in during a period of inflation. Growth. During period of growth, businesses have an increasing demand, the increasing need for more non-current asset and for its increasing working capital. Seasonal business. When a business has a seasonal or cyclical sales, it may have a cash flow difficulties at certain times during the year. One of item of expenditure. Sometimes a single non-recurring item expenditure make a create a cash flow problem. Managing cash flow problems. Cash flow problem can be eased by taking a number of steps. Postponing capital expenditure. Some capital expenditure can be postponed for a year or so without serious effect on company's long-term performance. Accelerating cash inflows. Business can increase its receivables to pay early through discount on early payment. Reversing past investments. Some assets that are not crucial for business survival can be sold during poor period of severe cash flow problem. Negotiation with account payable. This involves the following: long credit can be taken from supplier. Loan repayment can be rescheduled through negotiation with bank. Dividend payment can be reduced. Treasury management. Treasury management can be identified as corporate handling of all of financial matters, the generation of external and internal fund for a business, management of currencies and cash flows, complex strategies, policies and procedures of corporate finance. Treasury department can be centralized or decentralized in an organization depending on its needs. Both have certain advantages associated with them. Advantages of centralized treasury department: large volume of cash is available to invest, leading to better short-term investment opportunities. Borrowing can be arranged in bulk at lower interest rate. Foreign exchange risk will be improved through matching foreign currency income earned by one subsidiary with expenditure in the same currency by another subsidiary. Treasury management will be efficient because the centralized treasury department can employ expert. Liquidity management will be improved to centralized treasury department. It avoids having a mix of cash surplus and overdraft in different local banks. It facilitates bulk cash flow, which will result in less transaction cost. Advantages of decentralized treasury management. Advantages of decentralized treasury management: greater autonomy will be given to subsidiaries. A decentralized function may be more responsive to needs of individual operating units. Sources of finance will be diversified. Holding objective of holding cash. John Maynard Keynes identified three reasons for holding cash. Transaction motive. Every business needs a cash to meet its regular commitment of paying its account payables like employee wages, taxes, or annual dividends. Precautionary motive. There is a need to maintain a buffer of cash for unforeseen contingencies. Speculative motive. Sometimes business holds surplus cash as a speculative asset in the hope that interest rate will rise in future. Cash management, Baumol model. Okay. The Baumol model is based on the idea that optimum cash balance is like deciding an optimum inventory level. It uses the same EOQ formula that is used to calculate the optimum inventory level. Quantity equals to 2 Cs. 2 cost per sale of securities, and as this amount of cash to be used in each time period, optimum amount of cash to be raised, amount of cash to be used in each time period, cost for sale of securities, interest cost of holding cash or near equivalent, interest rate on new borrowings, interest earned on invest minus interest earned on cash investment. Example, find your company faces a fixed cost of $4,000 to obtain new fund. There is a requirement for $24,000 of cash over each period of 1 year for the foreseeable future. The interest cost of new fund is 12% per annum. The interest rate earned on short-term securities is 9% per annum required. How much finance should finder raise at the time? Okay. Cost of holding a cash is 12% minus 9% is equals to 3%. The optimum level of quantity, recorded quantity is 2 into 4,000. 2 into 4,000 is annual fixed cost into 24,000. 24,000 is requirement of 24,000 cash over each period of 1 year. 24,000. Okay, it is cost of equals to 80,000. The optimum amount of new fund to raise is 80,000. The amount is raised every 80,000 divided by 24,000. I mean, its requirement for equals to 31 divided by 3 years means 31 divided by 3. Let's see. Every 80,000 divided by 24,000 equals to 3 years. 3 years and 4 months. 3 years, 4 months. Hey. But yeah. 3 years. 80,000 divided by 24,000 is 3 times. 3.33 times, like that. Okay, advantages and disadvantages. Miller-Orr model. The Miller-Orr model focuses on an optimum amount of cash that a company should hold, which is called return point. The model then sets an upper limit and lower limit of cash balance, which should not be crossed. If a company reaches an upper limit, it should buy market securities return to the return point. If it reaches the lower limit, it should sell some securities to reach the return point. If a company reaches an upper limit, it should buy market securities to return to the return point. And if it reaches lower limit, it should sell some securities to reach to the return point. Calculating return point spread equals to 3 into transaction cost into variable cost into cash flow into 1 by 3. Return point is lower limit plus 1 into 3, 1 into spread divided by 3. Example, the following data applies to a company. The minimum cash balance is 8,000. The variance of daily cash flow is 4 million, equivalent to standard deviation of $2,000 per transaction per day. Okay, and this is the transaction cost for buying or selling securities is $50. The interest rate is 25%. The minimum cash balance is 8,000 to company. We are required to formulate a decision using Miller-Orr model. Transaction cost for buying or selling securities is 50. The interest rate is 0.025. The spread between upper and lower cash balance limit is calculated as follows. Transaction cost is 50. 400,000 variance cash flow is 400,000. So 3 into 50 into 4 million by 3. 1 by 3 into 4 million root